We have a retirement crisis, and what we need to do is figure out how do we get the right solutions to the broadest audience as quickly as possible. An annuity provides you with money when you need it most, and at the time when you probably have the least other options. My view is that the entire financial services industry has sort of evolved into being what I call merchants of complexity, who spend their lives looking for opportunities to earn an explainer premium. And so that's the problem that we're trying to solve. Like this is more than a business for me. This is a mission. In my mind, life insurance companies in some ways are one of the most important, it's one of the most important industries in this country. They're stepping in to fill this breach that corporate America has walked away from. So my name is Ramsey Smith. I am the founder and CEO of ALEX.fyi. I founded ALEX.fyi after I left a long career at Goldman Sachs because I thought there was a remarkable opportunity to change the way annuities and other guaranteed lifetime income products were being marketed and sold in the market. I thought there was a huge opportunity for greater education, greater transparency, and most importantly, an even better user experience.
So what's wrong with the way retirement products are currently sold?
It was really an interesting evolution. So while I was at Goldman, we spent a lot of time working with the largest life insurance companies in helping them hedge at a corporate level, hedge all of the market risks they were undertaking by selling annuities to consumers. And it was later in my career that we started helping the insurance companies actually develop new and different products that actually incorporated our branding as well as our investment technology, if you will, so strategic investment strategies. And in doing that, we were asked by our insurance carrier partners to go out on the road with them and help them distribute the product. And so that was the first time I'd actually gotten much closer to how the products are distributed. You know, the relationship with wirehouses and agencies, independent marketing organizations, and agents. And I was struck by a number of things. One of them was that it struck me as a business that had not probably changed that much in 30 or 40 or 50 years. The typical sale still happens over a kitchen table. The applications still tend to be done on paper. And I was very struck that this was the case in at that time, 2015, but even in 2020, that's still the case. And so it was very clear to me there was a potential to do a few things. One was to focus on simpler products that could be that would be accessible to a larger audience, and two, to try and in that process create more efficiencies in terms of the way that the products are sold, and three, narrow the information gap between the person selling the product and the person buying the product. The way I like to think about it is that in the current model, you may sit down with an agent, and the agent will have a product that might be particularly complex. And no matter how good the agent is at explaining that product, at a certain point, you as a consumer will likely have to make a decision. Either I don't entirely understand this, but I trust this person that I'm talking to, so I'm going to go ahead and do it, right? Or in the rare circumstances, I really totally understand this, and I'm going to go ahead and pull the trigger. But what bothers me is there's probably some significant population that just says, I don't understand this, and I don't necessarily understand this process or trust it enough yet to pull the trigger, so I'm going to walk away. And that's a big problem because annuities address a very, very critical need in the country right now, which is guaranteed income.
Why is guaranteed income important to retirees?
So it's important for a number of reasons, and I'll start with the psychological elements of it. So throughout our entire lives, whether it's through jobs or whatever other sources we have, we're used to actually getting a paycheck or something equivalent to a paycheck. That is actually a very normal paradigm. And what a strange thing to then go into retirement where you no longer have a steady paycheck, except for Social Security, which won't necessarily meet all of your needs. You no longer have a paycheck. You have a nest egg that is largely at risk every day in the market, and you have to draw down on it. And the size of that nest egg is moving around dramatically, and it's very hard to translate on a day-to-day basis. How does the relationship between that nest egg growing and shrinking relate to my ability to actually fund the rest of my life? And in the old days, the way that problem was solved was through some combination of Social Security and the traditional defined benefit pension plan, the pension plan that that our parents or our grandparents had. Those have largely gone the way of the dinosaur. They've largely disappeared. And even some of the remaining plans that have held out, like General Electric is a perfect example. Late in 2019, they announced a couple of things. One, that they were going to freeze the pensions of a large group of current employees, and that they were going to offer buyouts to a very large group of former employees that were already collecting or potentially going to collect. And that is a pattern we've seen for a long time. So there's a small fraction of the people that could have depended on a pension 20, 30, 40 years ago can still do so today. So this comes down to sort of a critical element of the life insurance industry that I think is largely not entirely understood or appreciated. And it is this: they are providing a service that nobody else is providing. In my mind, life insurance companies in some ways are one of the most important, it's one of the most important industries in this country. They're stepping in to fill this breach that corporate America has walked away from, that the government, for all its great intentions, and Social Security is an amazing program, it's a great program, but it has its limitations, current and in the future. The life insurance industry is actually stepping in to fill this breach in a way that no other industry is. And that fact is underappreciated, and I think that part of the reason it's underappreciated is because the old user experience in this space was not built around the transparency and ease of use and convenience and education that we've become used to in the current environment, whether it's Amazon or Uber or whatever we do these days. There's this expectation that I'm going to understand what I'm buying and why, how much it's going to cost me. That is not the way. Really, the entire financial services industry, but certainly elements of annuity products have been delivered, and so that's what we're looking to change.
Is there a complexity problem in the annuity space?
I'm going to answer that question in a generic way, because I don't want to pick on the annuities industry. I think it's endemic in the entire financial services industry. And as somebody that spent 21 years in equity derivatives, I was part of that, right? So essentially, as sophisticated providers of financial services, there is a tendency to look for complex solutions to complex problems for two reasons. One is that the margins tend to be there. There tend to be better margins in place where there are complex problems because there are fewer people that can solve those problems. And the other element is that to the extent that you focus on more complex problems and solutions, then you as the provider have inherently created a role for yourself as an explainer. So I call that the explainer premium. My view is that the entire financial services industry has sort of evolved into being what I call merchants of complexity, who spend their lives looking for opportunities to earn an explainer premium. And again, as somebody that did that for an entire career, I understand the logic behind that, and a lot of good things come out of that. A lot of good solutions come out of that, and that's great. However, we have a retirement crisis. This is the whole point of this module you're doing here at Real Vision. We have a retirement crisis, and what we need to do is figure out how do we get the right solutions to the broadest audience as quickly as possible. So one of many aha moments I had over the years with respect to complexity, actually happened in my old job. So I worked at a financial institution that was filled with some of the brightest minds in the world, particularly with respect to sophisticated financial products and financial engineering. And I can't tell you how many times some of the smartest financial engineers that I worked with would approach me and say, an agent showed my Aunt Millie this product. I spent an entire weekend trying to understand it from the documentation, and I totally don't get it. Can you help me? And it struck me that if this is a challenge for the world's brightest financial minds, then it's also going to be a challenge for for mom and pop. And so I think that there is a tremendous opportunity to get back to that which is simple, to get back to spring water and away from fancy drinks with umbrellas in them, right? That's what we're trying to do. And in particular, the reason it's important is because I think it really focuses on what life insurance companies do so uniquely and better than everybody else, right? They do two things better than everybody else. They help protect you against dying too soon. That's what we call life insurance. It's really death insurance, but we call it life insurance. They also help protect you against living too long. So I want to stop there for a second because you have to think about that for a second. Living too long, living a long time sounds like a great thing. And spiritually, it's fantastic. It's great for your family. It's great from a lifestyle perspective, potentially. But there's a real financial burden associated with living longer than you might have expected from a financial perspective. And a life insurance can help protect you against that with a simple income annuity.
Can retirees build bond portfolios on their own?
I end up getting into some interesting conversations with, it could be with financial advisors or it could be even individual consumers who will say, well, I can just do this on my own, right? I can build a portfolio of bonds that will give me the same payout as an annuity. And when I have those conversations, what I try to do is I try to give people things to consider. So I don't feel it's my job to talk them out of it because they have a very strong belief that that's the better way to do it. But I do try to give them considerations, and with those considerations, they can start to ask themselves questions about whether or not they've reached the right conclusions. So there are a number of things. So one thing that you get sort of indirectly via an insurance company that you don't get if you do it on your own is you get professional bond management. So insurance companies are essentially like big bond managers. Like a fundamental part of what they do is they buy investment-grade bonds. They're very smart about it. They have relationships with issuers, so they can get things that are originated at good prices. I mean, they're in a position to get the best bonds at the best times. Much better than sort of an individual would be typically. So that's the first thing. Second thing is that if you're an individual and you have, say, $1 million, what is the likelihood that you're going to be able to build a fully diversified portfolio? You're probably not. And even to the extent that you are, do you have the chops, the capacity, or even the interest to actively manage this portfolio at age 65, 75, 85, 95, right? So reinvesting interest as it comes in when that's relevant. If a bond has a credit event, I mean, do you have the information or the ability to do that? My suspicion is that most of the time people do not. So that's one particular element of it. The other element that you can't replicate or be very difficult to replicate is this concept of pooling. So the other thing that an insurance company provides, again, this is totally misunderstood or underappreciated, is that an insurance company, a life insurance company, is a nexus point for a pool. Lots of different people from different parts of the country will all purchase policies, right? In an ideal world, that pool is a good cross section of people in the country, and with respect to their health and all sorts of other things that might play into sort of the quality of the pool. And as a result of that, as a result of the fact that there's pooling, the insurance company is going to actually be able to pay you a monthly income that is greater than the yield on the bond portfolio that backs the annuity. So just to put some round numbers on it, if right now you assume an investment grade portfolio yields 3.5%, I'm probably off by 50 basis points one way or another, but let's call it 3.5%, right? If you had $1 million and you invested that $1 million, you could take out $35,000 a year for the rest of your life, assuming you could reinvest the bonds as they mature. And again, there's all that active management you would have to do. Or you could put the $1 million, if you're a 65-year-old male, and this is critical because your age and your gender matters, but for a 65-year-old male is a typical example, you could get as much as $60,000 a year for the rest of your life. And that difference is largely explained by these, they're called mortality credits. I think they should be called survivor credits, because you really end up getting paid if you live beyond the average expected life of the pool. But they're called mortality credits.
What are mortality credits?
In the case of a mutual fund company, or again, maybe you have a financial advisor that manages money for you, or you do it yourself, you're going to own the bonds, the actual bonds. You're going to own a bond fund. If there are any defaults in that fund, you own them. So if 1% of the bonds in that portfolio default, then you've lost 1% of the value of your portfolio. You bear all that risk. That difference that we talked about between the payout of a bond portfolio and the payout of a life annuity that is effectively backed from the insurance company's perspective by a similar portfolio, essentially comes down to mortality credits. And the gory detail about what goes into that is sort of beyond the scope of this particular discussion, but suffice to say, it really comes down to this concept of pooling a large group of people, all of whom will live to an average age of, say, 85 years old, right? And some people are going to pass before 85, and some people are going to pass after 85. And the difference in the yield that you get, the payout that you get from a life annuity relative to an equivalent bond portfolio reflects that notion that, like, some people are not actually going to live to that average life expectancy. And so from the insurance company's perspective, they're able to pass on economics that both reflect interest, right, and then also reflect the life expectancy of the various members of this pool. So what does that mean if you're in the pool? So if you're somebody that has great longevity, and here's something that's very interesting, is that there's no medical exam here. So if you buy a big life insurance company, a big life insurance policy, there's a medical exam. But for annuities, there's no medical exam. So if you come from a family where there's a lot of centenarians, and you're healthy, I mean, you actually have pretty good insight into what your health is potentially. Buying an annuity is essentially a pretty interesting value proposition. To the extent that you live beyond that average age, right? You continue to get a payout every single year. Your effective return goes up the longer that you live. Now, I actually don't like thinking about it that way, because I think that doesn't actually tell the complete story. The more complete story, the more interesting story, is that an annuity provides you with money when you need it most, and at the time when you probably have the least other options. So one of the most important lessons I got in my 2+ decades at Goldman Sachs was a concept that we used to call right way risk. And in simple terms, right way risk is some kind of investment or risk that delivers for you when nothing else is delivering for you, that is working for you when you absolutely need it to work for you most. Wrong way risk, as you might imagine, is something that tends to do poorly when everything else is doing poorly, when everything else is doing poorly. So another word for all this is correlation, that is often used. But what's interesting about the use case for a life annuity, for an income annuity here, is that, put yourself in the shoes of somebody that's 85, 90, 95 years old. Person A didn't have an annuity, so they run out of money. Well, what are their choices? Can they get a job, I don't know. Maybe, maybe not. Do they have the physical capacity to work? Do they have the cognitive capacity to work? Cognitive decline is a real thing you have to worry about. But the person who has the annuity, whether they live to 95, 100, 105, 120, will still be receiving that money precisely when they have the fewest other options. I think that sometimes when we have conversations with people about the value proposition of an annuity and they're, say, 40 years old, they say, well, I could go back to work, I could invest in the stock market, I could do all these things. There's so many different choices that you have as a younger person that you don't have as somebody that's at that advanced age. And that is the specific problem that an annuity, a life annuity, addresses. And it's best thought of as an insurance policy, not an investment.
How do you make annuities accessible, cheap, and simple for retirees?
One of the things that is characterized by the annuity market is that there's a lot of noise, right? So you've got carnival barkers on all sides. You've got people trying to sell annuities. You've got people saying they don't like annuities. There's one RA who's made a lot of hay saying he hates annuities. I think everybody knows who he is. From my perspective, it's just really important to clear through all the clutter. First of all, we operate on a very sort of critical principle. We actually don't think that everybody needs an annuity. So, going back to the Aunt Millie example, if your Aunt Millie has $2 million in the bank and is able to live off of her Social Security check, then she has an annuity. It's her Social Security. It covers all of her basic expenses. She does not need an annuity. But the person that could use an annuity is somebody who has expenses, non-discretionary expenses, that are greater than their Social Security check, and we want to help them just cover that gap, and we want them to use the rest of their money to invest in stocks and bonds and other things that will allow them to have growth. So the critical issue here is we're not looking for a way for you to invest or allocate 100% of your money. We're actually trying to figure out what is the least amount of your nest egg that you can put into an annuity to solve that very specific problem, which is the gap between Social Security and those expenses you have that won't go away. And if that number is any more than 30% of your nest egg, then we would say to you, annuities aren't a solution for you yet. You need to reevaluate your expenses, right? And then we can have a conversation. So we have very specific guidelines. We're looking for an optimal solution to a very specific problem, and that's different. I think that you could be an advisor or a planner that likes to solve most problems with stocks and bonds, and when you meet a client, you'd like to get 100% of their assets and help them solve problems with stocks and bonds. You could be an insurance professional who believes in various types of annuities, and you'd like to get the consumer to put 100% of their annuities, 100% of their assets in annuities to address the same problems. And what we say is the right answer is a mix of both of those solutions. And in fact, the annuity is the smaller part of that answer. Again, 30% or less of your portfolio. And so that attitude, that mindset, in and of itself, I think is very different. So taking a step further, another problem that I see, again, across financial services, is not just in the annuity space, is that there needs to be more transparency about economics. So what does the person selling me this annuity get paid for providing it? And what does this person get paid for providing annuity A versus B versus C? I think there should be total transparency there. That has not been part of the culture historically, but we've committed in the national press that we will be fully open and disclose. The next piece is this delicate balance between education and simplicity. So when I first left Goldman, I actually was still planning on focusing on annuities that were a bit more complex than the ones that we're focusing on now. And I had this notion, and I found out later it was a naive notion. I had this notion that I'm good at explaining this stuff, so we're gonna be better explainers, right? And that's gonna close this gap. And what I found is that you still have to be a better explainer, but you can close the gap much more quickly if you just simply focus on simpler and easier solutions. So it's this real commitment that getting the consumer as close as possible to a comfort zone where they understand what they're doing and why has to be the primary goal. And the closer you can get to that, right, the better. So if that means giving up the explainer premium we talked about before, if it means being a merchant of simplicity instead of a merchant of complexity, then that's what we're going to do, because that's the right thing. That's the right thing for the end user, which in this case is the American consumer.
How does ALEX.fyi fit into all of this?
Okay, so the name of our company and the name of our website is ALEX.fyi. The name was inspired by Alexander Hamilton, a hero to many of us, including my whole family, largely because of the Broadway show. The goal of ALEX.fyi is to provide consumers with tools that will help them get smarter about their retirement decisions. So, up until now, a lot of that has been reflected in our blogs and our articles, and over time, we're gonna add other tools that will help accomplish that. Now, we've made a pretty important change in 2019 in terms of how we're interacting with consumers. So originally, the idea was that we were going to be very much a direct-to-consumer play, where a consumer could come to the site, they could put in their information, and they could buy an income annuity. And what we learned on the basis of a lot of customer conversations was that it's a decision, because it may end up involving as much as 30% of your nest egg. It's a decision that you're unlikely to make very quickly in an internet transaction like going to Amazon. There is likely going to be a need for some human involvement with issues around planning and tax optimization. So the pivot that we've made is to focus more on working with financial planners and financial advisors who want to learn how to incorporate annuities into the offering that they give to their clients. And we made that decision, again, because we're putting the client first. Like, we're actually giving up economics to be able to do that. But when we thought about what makes for the best customer experience, we decided that for a transaction that big, you needed to have other skill sets involved. We decided that involving planners and advisors had a number of benefits. For one thing, it allowed us to ally ourselves, collaborate with the best and the brightest in the planning and the advisor community. And we know that those planners and advisors distinguish themselves by providing a high standard of care. And so for us, the number one thing is, what is the standard of care for the consumer? The other element that was valuable for us is that we figured out that if the goal here is to bring this solution to the widest possible audience, what it does is that every relationship we have with a planner and an advisor means an indirect relationship with all of their customers. So we get higher standard of care, and we have more reliable scalability to solve this really important problem if we work with the best planners and advisors in the country.
Who do you think is most underserved right now, companies or individuals?
We're a startup, and so we're looking to engage with smart people, smart, competent, thoughtful advisors and planners. I think, in the long haul, what that probably looks like in a world where RIA practices are being consolidated very quickly, it will probably translate into relationship with large RIA organizations, or in some cases the aggregators of the same. But until then, and hopefully always, to the extent that we find individual practitioners that are conscientious and we think provide strong value to their consumers, there's a place to work with them, for sure.
What are the key products you focus on?
We've decided to focus on a few very simple products. So primarily income annuities, so immediate annuities and deferred income annuities. An immediate annuity is simply a transfer of a lump sum to a life insurance company, and starting 1 month later for the rest of your life, they will make you a monthly payment. It's as simple as that, and it's as close as you can imagine to a defined benefit pension plan or Social Security. A variation of that is called a deferred income annuity, and it's essentially the same thing, except that instead of taking your money effectively on day one or 1 month after you give the insurance company the money, you might defer it out 10, 15, or 20 years. So somebody that buys an immediate annuity is probably at or in retirement, like just near it or in retirement. And the person that buys a deferred income annuity might often be somebody who's 40 or 45 or 50 who sees it as something that will be relevant to them somewhere down the road. So if you're still working, you're not going to buy an immediate annuity. You're going to buy a deferred income annuity to start whenever you expect that you're going to stop working. One other category of annuity that we're just starting to ramp up in, which we also think is very important, and it has a horrible name. It's a multi-year guaranteed annuity. It's an unwieldy name for a very simple product. It's best equated to a CD. So you give $100,000 to the life insurance company, and the life insurance company will guarantee you a rate of interest every year for some number of years. So if you choose a 5-year policy and they guarantee you 3%, every year your account will accumulate 3%, and at the end of the year at the end of 5 years, you'll have your original principal plus the compounded interest on that 3% a year over that time. A critical difference with CDs, and this is not tax advice, but a critical difference is that you can defer your taxes. CDs are extraordinarily tax inefficient. Like the equivalent in a CD accumulates that interest, and you have to pay the tax man every year. Even though you're not touching the interest yet in a 5-year CD, you've got to pay tax on it every year. So it's not tax efficient at all. And with an annuity, at the end of 5 years, you can decide to take your money, which you're probably not going to want to do if you're below 59.5, because there is an IRS penalty, or you can roll it over into another annuity and continue to defer that the taxes on that interest until you take out your money at a later stage in life. So for people that are 60 and over, I think it's a very attractive alternative to a CD. And I think for people under 60, it can also be attractive if that money is not needed in the near term.
What about reinvestment risk?
One of the things that's often asked about multi-year guaranteed annuities is what about reinvestment risk? I.e., at the end of my 5 years, will I have to reinvest at a lower rate? And the answer is you might. If interest rates are lower, you can expect that the rates of any annuity really, but it's easiest to see in a multi-year guaranteed annuity. The rates are going to go up and down as interest rates go up and down, because the insurance company, the way they're providing you with that interest is they're backing that product with a portfolio of largely investment grade bonds. So that is always there. The way you can combat that is if you happen to have a view that interest rates are going to go lower, you can invest for a longer time frame. But again, that's a level of expertise that you may or may not have. Buying a multi-year guaranteed annuity does not solve the ups and downs of interest rates. What I will say is that MYGAs, which is what they're called, tend to have higher rates of interest than equivalent CDs, and as I said, they've got tax deferral built in. The other element that people often ask about is inflation, and to that I say, yeah, like inflation is something that we all have to think about, and the only, and this is not investment advice, but the only assets that I think, can, with greater deal of reliability, help you deal with inflation are equities. Some would say gold. I'm not a believer in gold, so I'm going to leave that aside, right? But your best opportunity to keep up with inflation is to be invested in equity markets. Again, not investment advice. So bonds don't protect you against inflation any better than investing in an annuity or anything else. Like I think of annuities as a bond equivalent, And we've talked about the kinds of things that that the advantages annuities have, but the disadvantages around reinvestment risk and around inflation are common between those two solutions.
How do annuities affect you and your family?
Earlier in this conversation, we talked about the concept of right-way risk. We talked about this idea that that one of the key benefits of an annuity is that it will be providing money for you at a time when you most need it, when you have the least number of alternatives or other options, i.e. when you're sort of at a very advanced age, where you may have physical and cognitive limitations that might prevent you from going and getting a job or finding income elsewhere. And there's another sort of part of that story that I think is very interesting, is that if you're somebody that doesn't provide yourself that type of protection, and you decide, well, I'm willing to roll the dice, right? And you do end up being that person that runs out of money. Well, who's going to be holding the bag? Well, either it's society, or more likely, it's your family. It's your kids, your grandkids, et cetera. So, if you don't provide that protection for yourself, I've always sort of taken the view that essentially you've decided that your family is your insurance policy. And I would just say, make sure they know that, right? Make sure they know that. They may not realize, and they may not realize what the cost of that is. So, I think that this notion of ensuring your own longevity isn't just about you. It's about the people around you and the people that you care about. That's why thinking of it in pure investment terms, thinking of it in of internal rate of return terms, I think is a very, very incomplete formulation. It really is an insurance policy, and again, it's insurance policy for you and for your entire family.
Has the end of defined benefit pension plans shifted the risk to the consumer?
One of the interesting things that sort of comes up in conversations with lots of people when I talk about what we're doing is people are surprised to find out that, I love Social Security. I think it's a fantastic program. It's got funding issues, which concern me, but I like what it does. I love defined benefit pension plans. I think that they're amazing as well. Again, they're amazing for the end user, but I think what we found in both those instances is that neither is entirely sustainable. Right? So defined benefit pension plans are clearly not sustainable, or they wouldn't be disappearing so quickly. And Social Security, as it stands, unless something changes, is going to have to cut their the benefit levels by 20% by 2035. Things may change, but that's what we know now. So I like all those things, and when I made the decision to make this jump away from being an investment banker or a derivative specialist, financial engineer, to doing this, I asked myself, all right, annuities, are these an important product? I think they are, but let me really take a closer look at it. And as I looked at it closer and closer, I realized there's this fundamental service that was provided by corporate America and by the government that is essentially going away, that the need for this has absolutely never been greater, at a time when the value of the product is least understood, and at a time when the product is delivered in a fashion that is 50 years old, in a world where we can do things better. That was what I saw as the opportunity, and so yeah, I like exactly what DB plans do. I like what Social Security does. It's just not enough of it. And so that's the problem that we're trying to solve. Like this is more than a business for me. This is a mission. This is a mission. This is something that's mission critical for the country. It's not it really is. It's more than just dollars and cents.